Okay, I'm back again. I'm going to talk for a few minutes about transaction analysis. And again, with transaction analysis, as I mentioned in the previous recording, we have our assets equals liabilities plus equity. That is our accounting equation. Again, these are called elements. Underneath the elements are the respective accounts: cash, accounts receivable, and office equipment. Under liabilities, here we have accounts payable. And then under equity, we have common stock, dividends, revenue, and expense. What you will do here is you would actually use this, picture an Excel spreadsheet, okay? You would have columns for each one of these, and then all the rows would be transactions. So here is a list of transactions that is occurring for a particular business. The first one, Lita Lopez invested $70,000 cash and office equipment valued at $10,000 in the company in exchange for its common stock. So what's happening here? What's going on in this particular transaction? Well, Lita contributed $7,000 in cash. So we have our cash account here. So we would show a plus 70,000 in the first row. Okay. She also gave $10,000 of office equipment. So in that same first row, we would have plus 10,000 in office equipment. Now, the total there, because assets, remember, it's additive. We can sum those. So the 70,000 in cash plus the 10,000 in office equipment means we have $80,000 worth of assets. And remember what I talked about with liquidity. The $70,000 in cash is very liquid. The $10,000 in office equipment, less liquid. Okay, so, but that's only one side of our transaction. So the other side of the transaction is that she exchanged this for common stock. And so what do we do here? Well, we just said that assets were increased by $80,000. And so the equation assets equals liabilities plus equity always has to be true. So if assets equal $80,000, then liabilities plus equity has to equal $80,000. And in this case, all $80,000 was used to purchase common stock. So you'd have plus $80,000 in the common stock account. And so that would be the first row in your table or spreadsheet. Let's do another transaction here. Second one, the company purchased an office suite for $40,000 cash. Now, for argument's sake, I'm looking at an office suite, and I'm assuming that that is literally an office suite, like a place where you would go to work. And so since they purchased it, we would have that as an asset. Okay. The way the language there is, it's a little muddy. I don't particularly like the wording on this transaction, but we're going to live with it. And so typically what you would have is, again, you'd have plant, property, and equipment. Well, this would be considered, your office suite would be part of plant, which is a physical location. Okay. And so you would be debiting the asset account for $40,000. Where did the rest of it come from? What's the other side of this transaction? Well, it's another asset account. It's cash. Because what you did is you took $40,000 out of the cash account and you gave it to somebody for an office suite. So you've recorded the office suite at $40,000 in your accounting records. You now have to subtract $40,000 from cash. And so under cash, you'd have minus a second row, minus $40,000 in cash. And for argument's sake, we'll just say plus $40,000 in office equipment. Okay. So hopefully that's pretty clear. We will do one more. Okay, just to clarify. So let's look at C. The company purchased office equipment for $15,000 in cash. Okay, so at this point, we started off, remember, we started off with $70,000 in cash. Okay, then we purchased an office suite for $40,000 in cash. So that means the balance in cash is $70,000 minus $40,000. So we have $30,000 of cash remaining. In C, we used another $15,000 of cash to purchase additional office equipment. So that means we had $30,000 in cash minus this $15,000 we just dispersed. So that means we have $15,000 in cash remaining. And we now have $15,000 more dollars added to our office equipment. So we have $10,000 of office equipment here. We have an office suite of $40,000, so that's $50,000. And then we have additional office equipment of $15,000, right? So that's $65,000, all right? $65,000 in assets here, plus $15,000 of cash. We still have the same $80,000. And what's on the other side of the equation? The common stock of $80,000. That's still there. So through these first three entries, the equation, assets equals liabilities plus owner's equity, is still in balance at $80,000 on each side. So you see how that works? Okay, we'll do one more before I call this video to a close. D, the company purchased $1,200 of office supplies and $1,700 of office equipment on credit. Okay, the on credit part means they didn't use cash. What they did is they basically borrowed the money. They bought it on credit from their vendor. And so the office supplies we could recognize as office supplies expense. We'll use, remember the two methods I went over. For argument's sake here, because of the accounts we have listed up here, we do not have an office supplies inventory. So we're just going to assume that it's been expensed right away. And so we've purchased $1,200 of office supplies that get expensed right away. And so it's going to show up here as plus $1,200, okay? And it's going to show up on the fourth row of the spreadsheet that you'd be putting together for your transaction analysis, okay? So you'd be recognizing $1,200 of office supplies expense. At the same time, you're going to be recognizing a liability, a current liability, an accounts liability, and that's going to be for the $1,200. The other piece of this is that you purchased $1,700 of office equipment on credit as well. And so here, what we're going to do is we're going to have plus $1,700 for office equipment on line or row 4. And then we're going to have an additional accounts payable for $1,700. So that our accounts receivable balance is $2,900. We recognize expense, right, of $1,200, and we recognize office equipment of $1,700. And when you balance all of these, if you were to draw a line under these and record the balances again, you would find that the accounting equation, assets equals liabilities plus equity, is still true. Okay, those numbers will still equal one another. And that's the way it should be for every one of these entries. And so each row is a transaction. Okay, so this is the way they work transaction analysis. That's the way this particular method works. How the accountants do it is using journal entries, T accounts, and the accounting cycle. All the different steps that you'll learn about the accounting cycle. All right, so I hope this helps a little bit, just trying to understand or get your heads wrapped around the pluses and minuses and what debits and credits stand for and what a normal balance is and how all this stuff relates to one another. It just takes time to think through it, to absorb it. It takes practice and it takes study. Okay, so I can't undersell that enough. The more practice you do, the more time you put into studying this stuff up front, the better off you'll be in this course and also your second accounting course. And for those of you that are management majors, yet a third accounting course that you have to take, which is really about understanding the financial statements from an analytic perspective. So it's about doing more analysis on the financial statements, but being able to put context to what you're seeing. And in order to be able to apply context to a situation, you need to understand it. And so when we're talking about financial statements, you need to understand where the numbers came from. And this is how you know where the numbers came from. Okay? Well, thanks very much. And again, I'll be doing more of these as we move through the chapters based on the feedback I get from you guys in the reflection posts.